Hi, I'm Matt McAleer, President and Director of Private Wealth at Cumberland Advisors in Sarasota, Florida. I'm solo today with John Mousseau, our CEO and Director of Fixed Income on the Road. Today, I will be discussing my thoughts on the second quarter of 2024 and how action in both the equity and fixed income markets affected the Cumberland strategies over this period. Let's start with our broad equity strategies. U.S. Core ETF. Well, some things have not changed. It's been a large cap growth market for really the last 5 months. January had some, dispersion amongst the different cap sizes. So large cap growth performed very well. In terms of how we approach this specific strategy is in a diversified manner. So the mid cap and some of the value areas of this strategy have continued to weigh down on the performance. I will mention, and I've mentioned this on our Friday videos over the last couple of weeks, we are starting to register and witness some extremes in the dispersion analytics we look at between those class sizes, small, mid, large, as well as growth and value. When we start to get to these extremes, we want to at least recognize that there is the environment for a reversion to the mean trade. So we may see a little better performance out of mid-cap, out of value over the next 3, 4, 5 weeks. Let's move over to international equity. Really a 2 steps forward, 1 step back type of quarter. I call it a grind quarter. We were making money in some areas, fighting the trend in others. For the first time in really 4 quarters, emerging markets started to outperform developed markets the back half of Q2. Some of that was a rebound in China, but more than China was the real strength we saw in Taiwan and India. They're both holdings in the portfolio. They both performed awfully well. What didn't work in Q2 in the international arena? Latin America. Latin America had a nice 23, has really sputtered. There was some news off of elections in Mexico that caused some headaches. We do have exposure in the broad Latin America ETF, ILF. It was down during the quarter. And although it's only a 5% holding in the portfolio, we'll have to deal with that size-wise going forward. Active passive. Quick overview. Active passive, what is it? Active passive is our balanced strategy where we are 60% domestic equity in the form of the S&P 500 and the mid-cap 400. Complemented in this strategy is a fixed income allocation. That allocation can either be individual bonds, taxable or tax-free, and or ETFs. So very solid quarter for our active passive strategy. You would expect it to be solid, as the S&P 500 had a 3.5%, 3.75% return during Q2. So good solid movement. Mid-cap couldn't quite keep up with that, but does give us some diversification. The ratio in equity within that strategy is 2/3 S&P 500, 1/3 mid-cap 400. I will note that we do have a marker within the strategy that's been very effective for us. When equity or fixed income becomes 5% out of what we call ratio on our 60-40, so equity goes to 65, which then would force fixed income to 35, we'll trim equity, bring it back to 60, and buy fixed income, and vice versa. I will note that we're getting close to that 65 mark in a number of accounts, and we may have some activity over the next couple of weeks. Let's shoot over to fixed income. In our taxable strategy, we witnessed quite a bit of volatility in the Treasury market. Yields between 470 and let's call it 422 during the second quarter. So to get back to what we're looking to do, as we witness higher yields, we want to be more aggressive. We want to add some of those yields. As we see yields come in or tighten down to that 420 or 410, or even as we witnessed last winter heading into Q1 where we broke down through 4 to a 390. When we see that kind of activity, our fixed income department wants to be trimming, wants to take advantage of that strength. So the market will bounce back and forth. We seem to be bracketed in this 420 to 470, 475 area. In terms of how we're positioned, we've witnessed nice strength in our taxable munis and investment grade corporates. So we're starting to trim that area. We're starting to lower the allocation within our portfolio. That also allows us to maintain higher liquidity levels through Treasuries. This gives us quite a bit of flexibility heading into Q3. Over on the Muni side, Muni yields increased more than Treasury yields during Q2. Some of that was just a reversion off of the strength we saw in Q4 and Q1 in the Muni market. Some of the thinking there is that concerns over tax scenarios heading into the election were getting people to really increase demand in municipals. Keep in mind, supply is running about 30% above last year. So anytime you have more supply, price has to deal with that supply. So in terms of our Muni approach, similar to our taxable approach, as rates move higher, we want to be more aggressive on the buy side. As rates and yields fall, we want to take advantage of those stronger prices and trim. Back to equity. We have two thematic strategies which seek to identify areas of the market that can provide compounded growth moving forward. Our U.S. equity ETF really suffered the same headache, so to speak, as U.S. core did. Where growth was allocated to, it worked beautifully. But in a diversified portfolio and approach, we really struggled with some of the mid-cap and value approach within that strategy. Again, seeing some extremes in performance between growth and value, which historically has allowed value and small and mid, those out of favor areas, to begin to perform better. That could be this quarter, it could be next quarter. They never ring a bell on that. Tactical trend. Tactical trends had a wonderful run over the last 4 quarters. Q2 is a little bit of back and forth. Strength again out of technology. Our technology holdings were very strong. Microsoft strong. Some of our value-oriented areas, while not hurting the portfolio, didn't really give us much punch. Keep in mind, our largest holding in there is Berkshire Hathaway, and it was down a tick in Q2. In terms of tactical trend, we do have a fairly significant, call it 18, 19, 20% holding right now in short-term Treasury bills. That's earning close to 5.25% risk-free. We can use that capital for any kind of reasonable opportunities, whether it be growth, value, whether it be individual securities or ETFs. So in terms of what we'll be looking for heading into Q3 is to take advantage of some of that normal summer volatility. And we have a number of areas specifically in industrial and tech that we'd like to take advantage of any kind of pullback. I hope you enjoyed this video and look forward to providing you with more review content on the markets and Cumberland Advisors investment strategies on a quarterly basis. Feel free to reach out with any questions, and make sure to visit our YouTube channel where you can find other relevant content such as our Week in Review series or our strategy profiles. Thank you.